All right, first home buyers. We've got some awesome tips for you today. We're Healthcare Home Loans. You've met the team. Today is going to be an hour session talking you through the different lending tips for healthcare professionals. Tonight's agenda, we're going to talk a little bit about our business so you understand who we are and what benefits are available to you. Dominic will give you a little bit of a property update. And then we'll revert back to me. We'll talk a little bit more about lending, just a general update in the market, and talk about first home buyer basics Q&A. Healthcare lending specialist. Healthcare professionals, we're working with you to empower you to take care of your finances. A couple of things about us. Number one, we're independently owned. So we're not governed by any bank. It's just us. We work with a panel of 50 banks. So we've got a wide network of people that we can work with to find a home loan solution that best suits you. Three, it's tailored for you. Not everything is going to be one size suits all. Everyone's got unique financial situations, and we work with you and the banks to make sure we get the best outcome. And lastly, we're a free service to you. So we don't charge you for anything that we do. We get paid by the banks. The best part about it is we can work with you for 30 years. You can give us a call at any time whilst you've got your home loan or beyond that or before that, and we'll be there to support you. The difference. Our service is based on our expertise. We are constantly monitoring the banking policies to get the most for our clients. Our service is judged by the availability, the speed, and simplicity. We know that you work overtime. You have very interesting hours, working night shifts, early mornings, all sorts of hours, and we're there to support you working those early mornings with you and accommodating at late night. Speed's a really important thing. We understand that sometimes you found a property on Saturday morning or might be Wednesday and you're like, I just want to get to this property and make it happen. And we will work with you as fast as we can to make the loan super easy, super quick. And simplicity. We know that you know your work, you're great at what you do, and we're great at home loans. So we try to make things super easy and to understand, so that way when you're doing it, it seems less daunting. You're making informed decisions. Our specialty is healthcare. We work exclusively for healthcare workers, and our services are tailored to your profession. And we're also a premium broker. So we get preferential treatment from each of the banks, which means we get faster servicing times, access to senior bankers, and sometimes better rates. I'd say most times, to be honest. Healthcare benefits. So this is where it gets really interesting. As a healthcare professional, you actually get discounted interest rates with or without our premium service. You get these discounted interest rates. You have the ability to buy with smaller deposits, whether it's a 5 or a 10% deposit. You get the ability to have your lender's mortgage insurance waived, sometimes called LMI, and that's just a gross fee that you have to pay if your deposit's less than 20%. You also have the ability of an increased borrowing capacity. Whether you're doing casual work or full-time work, you're not going to be penalised for it. Strangely enough, sometimes it can be misunderstood. You're working all of these additional hours and banks will shade that. In your case, being a healthcare professional, banks won't shade it and they'll take 100% of your overtime income or bonuses that you do receive.
Shading means sometimes they'll penalize you and won't take all of that income or overtime hours. If you've worked $100 worth of extra overtime, sometimes a bank will take 70% or $70 or $80 rather than that full amount, which can have a huge impact for you hardworking individuals.
And to add to that, because you're working so hard and the banks value the hard work that you are doing, you get the preferential service from them. So they're going to look at your loans, as discussed earlier. Things happen much faster and you have a little bit more leniency when the loans are going through. This is just an example of the type of treatment that you'll get from the bank. So we've got Dr. David over here who's looking at buying a property at 1.5 million. His deposit, he can buy with a 5% deposit, which equals about 75,000. The loan's 1.425 million. The nice thing is that you're not paying lender's mortgage insurance, so $0, no fees there. The interest rate is significantly better than what you would get if you were paying with a 5% deposit. And just a note on that, when you buy with a smaller deposit, typically the banks deem you as more risky. So they tier their interest rates to a higher rate. So being able to have a smaller deposit and a better rate is the winner all round. And your payments typically tend to be lower because you're getting that more competitive rate and you're not needing to pay that lender's mortgage insurance. So when we have a look over here, on a $1.5 million loan, buying with a 5% deposit, you'll get hit with some hefty lender's mortgage insurance fees between $60,000 to $80,000, depending on which bank you work with. And also your interest rate would be much higher, reflective of the small deposit.
And I'll just say that most non-medical people trying to get a loan with a 95% LVR won't get the loan. It won't be an offer. And for people that are getting a 90% loan, they get extreme fees charged to them. This is an extreme circumstance, but it works at all levels.
Absolutely. And as you can see here, the repayments are less. So it does make a significant change or difference. Who qualifies? So there is a list of people who do qualify, and depending on what you do within each of these professions, you get different waivers. For example, dentists and general practitioners and hospital employed doctors, they'll get a 5% deposit on investment loans. Whereas if you're working as a midwife or a nurse or a podiatrist, you'll be able to access, or allied health as well, will be able to access a 10% deposit on both first home and investment and not need to pay the lender's mortgage insurance. Okay, property market update. Over to you, Dom.
So I'll try not to make this is a first home buyers event, so I won't make it as exhaustive as I normally do. This is a Corelogic report. You can download them from corelogic.com. They do it every single month, and they have accompanying videos where a gentleman named Tim Lawless will talk you through the report. They're normally 10-minute videos, so I'll try and do the same. The long story short is residential real estate underpins Australia's wealth. That's probably why a lot of you see why the government really does support, a lot of their policies are towards supporting the property market, because it's just a huge, huge beast and many, many Aussies are invested in it. The general trend of the property market is that although growing in most markets, or as a general, it is starting to slow down. So the national home values rose over the last quarter by 1%. This is the softest quarterly rise since the 3 months to March in 2023. So we've seen a lot of growth recently. It's still growing generally, but it's slowing down a lot. The annual pace of growth has actually also continued to slow from a recent high of 9.7%. The capital city values rose by 1.1% over the quarter, down from 2.1. By comparison, the regions rose by 1%. Now, the general trend which you're going to see is the more affordable markets are growing the most, the more affordable cities, the more affordable markets within cities. And this is largely due to investor sentiment, but also affordability. We've had 14 interest rate rises, and we're starting to feel the pressure and the crunch of that. You can see here the top performing markets are regional Western Australia, South Australia, and Queensland. The other regional markets have been quite soft. And then for the major or the capital cities is Perth, Adelaide, and Brisbane. These quarterly growth values are stellar results. Canberra, Darwin, Hobart, and Melbourne have all dropped in value, and Sydney has just grown a little bit. The 12-month changes across Australia, it's been about 6.7%, which is still a huge amount of growth. on average, it's been about a 50K increase across the market for people that are in the that own property. You can see here that Western Australia, South Australia, and Queensland, the regional markets have grown very, very strongly at 10, 11, and 19% respectively. The capital cities, again, have performed very well. Perth has just absolutely shot the lights out, either 24% growth. Adelaide and Brisbane, about 14 and 14% each. Canberra has seen very slow growth, just very little bit. Darwin, Hobart's gone backwards. Melbourne has gone backwards. Sydney has performed pretty well. So you can see just this is a visualization of the growth of the capital cities and how it has performed over time. Perth has been performing very, very well. That's the rolling quarterly average. Sydney has performed, Adelaide has performed pretty well. Whereas if you see here, ACT, Darwin, and Hobart have been performing quite poorly, as well as Melbourne. Now, this is a very interesting graph. It's a mouthful. It's the quarterly change in stratified hedonic dwellings index. The very simple way of thinking about it is the yellow line is the lowest 25% of values in a market. The, I guess, cream or pink line is the 50% of values, and then the orange is the highest 25% of values. And if you see here that there's a trend, the lowest values, the cheapest parts of the market, have been performing the best, whereas the more expensive parts of the market, the orange lines, have been performing the worst. And again, we can attribute lots of this poor performance or good performance to interest rates and affordability. It's as simple as the more interest rate rises, the more expensive the property markets are, and then you'll see growth go towards affordability. So in these cheaper parts of the markets, that's typically regional centres, the fringes of cities, and then apartments and townhouses. I'll just keep on moving through. We've covered the cities and how they've been performing. Okay, sales and listings. Now, sales and listings is a really important metric. It gives you a sense of how the markets are performing. So transaction volumes tell you about how many sales are happening, and it tells you about the heat in the market. So you can see here that the annual transaction volumes appear to have peaked, or they moved past their peak, with sales in the last 12 months in September going down. You can see here that the easing month-on-month annual sales remains at 10.5% higher than the same time last year. So this, you can see 5-year average, that's that line there. And then the monthly sales volumes have been petering off, and the 6 months has been petering off. So there's been a lot of transactions, a lot of desire to buy properties in regional Western Australia, regional South Australia, and there's been a lot of transactions. The median days on market tells you about how long it takes for a property to sell. The longer it takes for a property to sell is an indication that that market's starting to slow down. So you can see here that the combined capital cities typically perform a little bit better than the regional centres. And you can see that this time last year, or excuse me, this is 27 days was this time last year, whereas now it was 27 days this time last year, whereas now it's 32 days. So it's starting to slow down a lot in those markets. And if you look at some of those hot performing markets like Perth, it's just 11 days to sell a property, whereas same as Adelaide, it's 26 days, and then in Brisbane, it's 20 days. Where those slower performing markets like Canberra, Darwin, Hobart, it takes way more time to sell those property markets. Again, same thing in Melbourne, 41 days compared to 27 last year. Now, listing volumes. This talks about how many properties are coming onto the market to be listed. The previous 5-year average is this dotted line, and you can see that we're starting to trend above that. Now, this is a seasonal thing. They call it the spring selling season, which means that during the spring and summer months, a lot more volumes come onto the market. People are wanting to sell. And you can see here that we're trending well above the 5-year average. And the reason is it's simple that as interest costs have gone up, it's become more expensive for people to hold property. So they're starting to sell their investments, and some people are selling their homes because it's too much, it's costing them too much to afford. And you can see that they're starting to list their properties, a lot more volume into the market. Now, the trend here is listings, how many listings are coming onto the market. Hobart, Darwin, and Canberra, Sydney, Brisbane, and Perth, have all seen stronger flow of new listings over the 4 weeks to October compared to the same time last year. And Brisbane is 4.2% higher than the same time last year. So there's a lot of heat in that market. This is another interesting metric, weekly clearance rates. For the people in Melbourne and in Sydney, the clearance rates, they're auction markets. Now, the clearance rates is the percentage or the likelihood that the property sold, or the percentage of properties that sold when they got listed. Now, typically 70% is a market that's remaining even or growing, but you can see that the percentage rate is starting to drop down to about a 60% clearance rate, which is indicative of markets that are starting to slow down and go into decline. Rental markets, for the people those of us that are renting, the rental market is starting to slow down. We saw record price growth from September 20 to 2021, and lots of growth, but it's now starting to slow and ease off. Though that's the case, it is still quite expensive. The average person that's renting is spending about 33% of their income on renting properties. And an interesting statistic is that for the average person that has a mortgage, they're spending about 50% of their income towards covering their mortgage. This is record highs. This is another interesting bit of data, dwelling approvals. Now, dwelling approvals are when developers submit to council for properties to get approved. And once they're approved, it typically takes between 12 and say 36 months for new houses or new apartments to be built. You can see this is a decade average here for houses. We're trending well below the decade average. And this is the decade average for apartments. And again, we're trending well below that. So this is indicative of a severe undersupply in the market. And that's the reason why, despite 14 interest rate rises, we saw a lot of price growth. Now, what this means is because there's a low supply coming into the market and there's still quite a high demand for property, that's why you see price growth. Okay, this is interesting as well. The value of home lending rose by 1%, so there's a lot of home lending in the market. Investor finance counted for the most of the monthly increase. So you can see that investors are starting to step into the market, with the value of new investor loans up by 1.4%. I would attribute this to people starting to anticipate that either late this year or more likely the beginning of next year, banks are seeing that interest rates are probably going to come down, and investors are sniffing this out. Now, property prices and interest rates have an inverse relationship. As interest rates go up, property prices typically go down, which is what we're starting to see. But as interest rates start to go down, property prices start to go up. So investors are starting to see that property prices may in fact go up because interest rates are going to go down sometime at the beginning of next year. Okay, and this is an important slide as well. The value of first home buyers finance fell by 0.4%. People are trending towards cheaper properties, and first home buyers made up about 28% of the value of owner-occupied lending, which is slightly down. The reason why we're seeing this is because interest rates have been sustained high for such a long time. First home buyers are typically more susceptible to prices. And because price growth has been high for so long in the property market, interest rates are high. first home buyers have not been as aggressive and slowly come out of the market. Anyways, that's me, the property market update. I'll stop sharing and I will now pass over back to Carla for her presentation.
So just off the back of what Dominic says, we'll jump into a quick lending update. The rates have remained on hold. Nothing has happened just yet. There are no safe bets with rate prediction. They are likely to hold until inflation is under control. However, speaking with all the major banks, NAB, CBA, Westpac, and ANZ, and Macquarie now, they've all said that, look, inflation is expected to return to the 2 to 3% target range in the second half of 2025. And what we're seeing from these banks is they have started decreasing their fixed rates, especially on the 2-year period. They've gone really hard. For example, Macquarie has reduced their fixed rates from 6% to 5.39. So banks are predicting that rates are going to start coming down soon. It's just a matter of when, and that looks like it might be in the first half of 2025. We might see a bit of reprieve, but we're just going to have to hold throughout Christmas because as the shopping starts happening and people get ready for the Christmas period, that's going to start increasing the inflation. So rates will remain on hold. We should start seeing rate decreases coming soon. I'd look out for it in the new year. Now, what we're all here for, first home buyer essentials. So what can we do? What opportunities are available to you? There are a lot of first home buyers out in the market, but as Dominic was talking about, some people are moving towards the investor path because there are some more opportunities to NAB. And of recent times, it's been harder for people to save deposits, to get their finances in order. So we're going to guide you through what it looks like to buy with little to no deposit, what government grants are applicable to you, and home buyer schemes. So we'll start off with guarantor homes. Now, there's a lot of writing here, and there sort of needs to be, just because guarantor loans are a great product for you if available to you. Guarantor home loans is when someone, either it's usually a family member, will use the equity in their property as additional security for your home. This can help you secure a mortgage with no deposit. So you can do 100% lend, no deposit, or a small deposit of 5% and avoid lender's mortgage insurance. Guarantor loans can work on both investment properties and on your own home. How it works is the guarantor is not responsible for your payments, you are, but in the event that you default on your home loan or something goes wrong, then your guarantor has to step up as it's their property being used as collateral. And so they will be liable for any outstanding debt. It is quite risky, and someone who does want to help you with your home loan, if they're going to be your guarantor, thank them absolutely, because they're doing you a massive favor by saving you that money and bearing that risk. Whilst this can fast track home ownership with your no deposit and saving money on fees, if you do default, it is a risk to them. And most lenders will ask that if your parents or a family member of some sort is going to be your guarantor, that they do seek legal independent advice to fully understand the risks. So that's an awesome one. Next up is your grants and schemes. So there's a couple of government grants and schemes that Australia has introduced to make sure that we can get more buyers in the market. One specific one is the First Home Owner Grant. It's a state-specific grant to help first home buyers with their deposit, and it varies state to state. So in New South Wales, it has to, this grant also is applicable to a specific buyer field, I guess. Sorry. So if you're buying a brand new property or something that's been substantially renovated, that's where the grant comes in. They'll give you up to $10,000 in New South Wales, $30,000 in Queensland, $10,000 in Vic, or $20,000 in regional areas, in some regional areas and states, which is amazing. The only thing you need to consider is it has to be a new property, and it has to be substantially renovated. I've had people say to me, well, they've put, new blinds in and they've painted the walls. That's renovated. That won't count. It needs to be something significant, like a new kitchen or a new bathroom, where you can then draw upon that. The next one is the first home guarantee scheme. This is something that is super beneficial to first home buyers because you can get in the market with just as little as a 5% deposit and not pay lender's mortgage insurance. So that applies to anyone in Australia buying their first home, or it could be for someone who has owned a property more than 10 years ago. So if you bought a property in the early 90s and then, you haven't owned a property in the last 10 years, you can come back into the market and buy with a 5% deposit or a 10% deposit and not pay lender's mortgage insurance, which is amazing. The next scheme is a family home guarantee. So this is for our single parents out there. Hats off to you, doing it tough and hard. You're working. So the government's had a look and said, look, we'll be able to do a 2% deposit for you and not pay lender's mortgage insurance, which is fantastic. And then, of course, we have a regional home guarantee, and that's just aimed at buyers in regional areas. You can buy with as little as a 5% deposit, no lender's mortgage insurance. We also have over here is it's a home guarantee scheme where it's a first home super saver scheme. So this allows first home buyers to save for a home deposit through your superannuation. It allows you to help buyers leverage the tax benefits of super to accelerate your savings. So you can make voluntary contributions to your super. And then once you've done all of that, you can pull out $50,000 for a home purchase, which is pretty cool because that can just happen in the background and you can make an agreement with your employer to just put those savings away. The only thing that you need to think about if you're going to do that is that you must be a first home buyer and you need to live in the property for at least 6 months within the first 12 months. So there's some eligibilities that you need to think about when you're thinking about these schemes. Next up is stamp duty concessions, which is another massive saver. So not only can you get into the market with as little as a 5% deposit, not pay lender's mortgage insurance, but you can also save on stamp duty. Many states offer reduced or waived stamp duties for first home buyers based on the property value. So a full exemption is in New South Wales is up to 800,000 with concessions up to 1 million, and same for Victoria. But they've got it up to 600,000 with concessions up to 750. Something that just came out in the last couple of days from Victoria is that they're actually going to waive stamp duty for any buyers, whether you're buying an investment property or you have bought a property in the past or you're a first home buyer. There is no threshold for what the price of the property needs to be, but it needs to be a brand new property.
And so it's not completely waived. The way it's calculated based on the unimproved value of that strata titled property. So, for instance, the unit may be valued at $1 million. They'll assess what the land content of that value is, and it might be $200,000. So instead of paying 40,000 or 45,000 in stamp duty, you'll end up paying like 5,000 or 6,000. Those numbers aren't accurate. That's indicative of what it looks like. It's a huge saving that's happened in Victoria, and it's only running for 1 year.
Yeah, only 12 months. In Queensland, you can get concessions up to homes for up to 550,000. WA, you get a full exemption up to 430,000 with partial concessions up to 530. In TAS, you get a 50% discount up to homes up to 600,000. In ACT, full exemptions for homes under 1.6 million, which is huge. And in Northern Territory and South Australia, there aren't any specific home buyer exemptions, but there are some general concessions that do apply, depending on where you're buying and how much you're paying for it. All right. Something that we've looked at the government schemes and the grants, and there's some amazing savings in there. But moving into what happens when we're looking at credit scores, credit cards, and everything else. And I think this is really important for a first home buyer. A lot of first home buyers that we speak with have probably never looked at their credit score before. So your credit score is a representation of your credit worthiness. The banks look at this to see if you've had a credit card in the past or you borrowed money in the past in some shape, whether it's for a car loan or a credit card or a personal loan, they want to see that you have a good track record. So it will determine the length of the history. It will tell them the types of credit that you've borrowed for. And based on how much you're paying and how often you're paying it, if you haven't missed any of your payments, you're going to have an excellent score. And those excellent scores sit above 800. But banks basically will look at anything above 600 onwards. Anything below that, that's when we workshop with you to have a look at mending your credit score. So don't worry if you've already had a look at your score and it's below 600, there are ways around it. Then there's ways to fix it and improve your score. But if it is above 600, you've got nothing to worry about. It's just something to be mindful of.
And I'll just add to that. If you're listening to this, watching, and you're like, I don't know what my credit score is. I'd like to buy a property and I'm interested. Feel free to send us an email, reach out, book a meeting. We can have that conversation. It's free for the chat. It's free to get a credit score, and we can put you in touch with people. If you do have a poor credit score, it costs a little bit of money, but they're credit repair guys, teams that can help you get your score back up to scratch and ready to go and buy some property.
There are some things to consider as well, just add to that. It's just the type of inquiries and things. So we'll chat you through that and we can have a look at how that impacts you and ways to improve it. Next up is credit cards. This is the big one. People always come to us and say, should I get a credit card to improve my credit score so I can show the bank that I have good repayment history? And I'll be honest, if you get a credit card, as long as you manage it well, it can improve your credit score. It can help you build frequent flyer points and help you manage expenses. So by all means, if it's for you, go for it. However, it does have an impact on how much you can borrow with the banks. So for instance, per $1,000 that you have in your credit card can reduce your borrowing capacity by about $6,000 to $8,000, depending on which bank you work with. For example, if you have a $10,000 credit card, it can reduce your borrowing capacity between $60,000 to $80,000. So keep that in the back of your mind when you're thinking about getting a credit card and looking to buy a property. What about buy now, pay later? Afterpay, Zip Pay, Hum, all of those can be great when you're going shopping, but it's not so great when you're looking to buy a property because the banks basically don't favor that and they think that these are risks to you. So be mindful that they'll often ask you to cancel these accounts if you're looking to buy a property. And sometimes that can happen with your credit cards as well. The bank might ask you, look, your credit card's $10,000 or $15,000. Can you reduce that so that way it's less risk to you? So be mindful of credit cards when you are shopping. Of course, we can help you with your application. So if you're looking to get a credit card with your home loan, we can discuss that as well. Questions? So we're going to talk a little bit about offset and redraw. We won't go through interest only because that doesn't actually apply to first home buyers, but I know that there's always some burning questions that others might be thinking. So by all means, ask in the chat.
Yeah, we've said a lot. So we'll have a quick 60-second break while you have a think about what questions you might have. Pop them in the chat. If you're brave enough, feel free to switch your video or mic on, ask them. But in the chat's easiest because then, sometimes it can be a bit muffled. No burning questions today?
Brilliant. I've answered everyone's questions.
Yeah,
But of
save your voice
course,
box.
if you are, I mean, sometimes it's not front of mind, and you can book a meeting and have a chat with us independently, and be more than happy to go through it with you.
Okay.
I'll go through the last one then, which is offset versus redraw. This is something we're getting really technical here, but I think people like to ask about this when they're getting into the thick of things. When we are setting up your home loan and we're doing a workshop with you, we will go through everything with fine detail to make sure you understand the type of home loan you're going for. Often people hear things, oh, what's an offset account, or what's a redraw account, or I want this, I must have this. And sometimes that will impact the type of loan that you get. So what's the difference? How do they work? Offset and redraw accounts work identically. They work the exact same way. I like to think of it as a handbag versus a backpack. So an offset account is your handbag. It's just accessible. It's right there. It's not attached to your home loan. It's its own transaction account. You can use the card to pay for things. You can get money transferred into the account. You can transfer in and out as normal. So it just operates as your everyday transaction account. And then you have a redraw account, which is like your backpack. It's attached to your home loan. So if you need it, you need to take off the backpack to get things out of it. If you need money that's sitting in your redraw account, you need to transfer from one account to the next to use that money. How does it work? Basically, if you have a home loan worth $200,000, and you've got a $10,000 saving sitting in your offset or your redraw account, rather than working the interest out on the $200,000, they'll reduce it by the $10,000 that you put in your offset or redraw, which means you're only paying interest on $190,000. What that means is that you're making more contributions to your principal repayment, because when you're paying your home loan, there's a principal and an interest component, and you basically wedge together. And for the first 10 years, you're paying more of the interest component. But when you've got money in your offset or redraw, it helps you make more of your repayment towards the principal balance, which essentially helps you pay off your home loan faster, and you pay less interest over the lifeline of the loan. So it's a really powerful tool to utilize if you can. I don't know if there's any other questions, team. You might have to.
There's two questions. So Amy asked the first question:
Okay.
is paying my HEX back early going to improve my credit score?
It won't improve your credit score, but it can help your home loan. Unfortunately, the banks won't consider government debt, which is a little bit unfortunate because everyone is paying back their HEX debt. But by paying off your HEX debt, it can increase your borrowing capacity, and it can stabilize your repayments. So it makes it a little bit easier in the long run.
But I will add to that, before you pay off your HEX debt early, probably have a chat to us. As Carla said, it does improve your borrowing capacity, but you may not need to get rid of your cash early. We do believe in keeping as much of your cash available as you can. So before doing anything like paying back your HEX debt in big lump sums, it's better to talk to a mortgage broker or an accountant just so you get a more holistic view on that. Second question is from Natalia. Could you please comment on price caps for the grant schemes you mentioned?
Yeah, of course. So, are we? I've got to throw back a question, but so are we referring to the price cap of the grant? Because if we're referring to the grant has a price cap of up to $600,000. So it has to be a $600,000 less than that. Anything less than $600,000 on the contract, you'll receive a $10,000 grant. And when referring to the government schemes in terms of buying with a 5% deposit, there is no price cap on that. You can buy with as much, you can buy up to 1 million, 1.2, whatever it is. They'll get you there though, because they do have a income eligibility. So as a individual, you can't be earning more than $125,000 per year. And judging by the 125, you can only realistically borrow up to so much. So no price cap on the property, but there is a price cap on how much you earn. If you are buying with a partner, your brother, your friend, whoever it might be, which is another thing I should mention, it used to only be for one person. If you want, it wasn't allowed to buy with another person in the past. Now you can buy with your neighbor, your best friend, your sister, your mum, whoever it might be. But you have to have a combined income of less than $200,000. So hope that answers your question.
I'll add to that. If you have questions about the different price caps, we would recommend you go to the government websites and have a bit of a read. It can be a bit confusing. Again, you can talk to us or any mortgage broker. They should be able to help you through that process. We have another question. So, excuse me if I pronounce your name incorrectly. Fabri, I didn't see carers that were eligible. Doesn't that mean we miss out on this? Sees everyone. I've seen everyone except carers. Fabri, that list isn't exhaustive. There are other people that are included in there, but I'll allow Carla to talk about carers and what the classification for a carer is and some of those benefits.
So with carers, you do have, as a first home buyer, if you're a carer, you get access to all of these benefits. You get access to the discounted interest rates, buying with a smaller deposit, and not paying lender's mortgage insurance. So you get all those benefits. If you're looking to buy it as an investment property, you will not, depending on what you do within a carer, because we have a lot of people, for example, who work with King Care, and they work, they're registered with APRA, but they're currently working as a carer. And so they will access the 10% deposit with no LMI, but on an investment. But you will get discounted interest rates, and we utilize that through our preferential relationships with the banks. They will give you discounted interest rates, which is amazing. And the other thing that you'll benefit from is they will take 100% of your overtime and any bonuses that you do receive, no matter if you're working full-time or casually. Something that people always ask me is, Carla, especially in the nature of healthcare professionals, it's often that you're chopping and changing roles or moving interstate or doing agency work of some sort. And it's usually a question of, can I borrow? Absolutely. Working the healthcare profession, working as a carer or anyone in healthcare really, you're considered as emergency service. So they will take 100% of your income. They will give you those discounted rates. So it's pretty awesome.
Yeah, that's nothing to sneeze at. Getting 100% of your income is a huge thing. And again, if you're a first home buyer, you get access to all those grants. So there are benefits that are available to you.
Absolutely.
And we have one more question here from another Natalia. Is it possible to apply for it being a ZZP? I don't know what the question is. Natalia, could you elaborate on what that question is?
Whilst I was doing that, book a discovery.
Self-employer.
Yep,
Excuse me.
absolutely.
Yeah.
If you are a first home buyer, doesn't matter whether you're self-employed or PAYG, you'll still get the benefits so long as you have the money to cover it. The thing to consider about self-employed is, depending on which banks we work with, they'll want different things. So some people say, oh, I've recently gone self-employed, but last year I was PAYG. That is a great consideration for the bank, because the bank will use your last year's tax returns. But if you've been self-employed for longer than a year, then the banks will just look at your returns and keep moving from there. So you still get the amazing benefits.
Okay. It looks like we've answered everybody's questions. This has been a really good session, everybody. Thank you for coming back. Oh, okay. Sorry. One more question. When I go to the bank, how do I get the eligibility? Because I didn't get. This is a great question. So Fabry has said, when I go to the bank, how do I get the eligibility? Because I didn't get that. Um, a lot of banks don't have the eligibility. One, two. Sometimes you walk into a bank and you may get junior, someone that doesn't understand the policy. So even if the bank offers it, you may not get it unless you explicitly ask for the eligibility or a medico path. I just had a conversation the other day with a poor lady who was a podiatrist and paid $12,500 in lender's mortgage insurance. Her ex-boyfriend wrote the home loan and screwed it up. So she paid a huge fee and it was unnecessary. The banks are not in the habit of giving away money. You have to ask for discounts, you have to ask for fee waivers, you have to write the home loan in the right way. Working with us is free. We get paid a small fee when we write the home loan with the bank. They pay us, it has no impact on your home loan. So yeah, you need to go to the right bank to ask for the eligibility. You have to write your home loan the right way. 70%, a bit more than 70% of all home loan origination now comes from brokers, and it's because of this that we can go and write tailored solutions for your needs. We're going to wrap up now, but before we do, feel free to grab your phone, scan that QR code. The meeting, it'll take you to a link to book straight into my diary. It's a 10-minute, 15-minute phone call to figure out what you're trying to do. We can answer your questions, and if we can help you, we'll book a loan solution. Anyways,
Just to add to it, Dom, as well, before we leave, we're going to be sending you this webinar. We're also going to be sending you a first home buyer's guide so you get a good look at
a checklist.
a checklist so you can get an idea of what to expect throughout the process, and if you are looking at properties, what to think about when you're buying them.
Have a good evening, everybody. We'll see you later.
Thank you.
Thanks, everyone.
Thank you.
Anytime.